When AI-driven capital spending, sticky inflation, and tightening liquidity all collide, the asset allocation map can shift very quickly. This is vTalkInsight, Allocator's Lens Daily for June 10th, 2026. Let us start with public equities, where earnings strength is now running straight into higher rates, heavy issuance, and a clear pickup in volatility. In equities, the core tension today is simple. Earnings and AI demand still look powerful, but the macro and liquidity backdrop has become much less forgiving. The S&P 500 has gained roughly 10 to 15% over the past few months, yet we have just seen a sharp down day of more than 2.5%, and the volatility index has bounced back toward the high teens from the mid-teens. On the supportive side, earnings expectations remain unusually strong, with forecasts for more than 20% growth this year and mid-teen gains penciled in for next year. AI-linked capital expenditure is a big part of that story. China's exports jumped, chip sales are booming, and data center investments, including a $300 billion build-out plan in China and long-term leasing deals in the United States, underline how durable the infrastructure cycle could be. Yet beneath the index level, the picture is far more fragile. Only about 1/5 of S&P names are beating the index, and just a tiny fraction are printing fresh 52-week highs, while the average S&P stock has already suffered a drawdown north of 20%. Multiple warning signals are flashing. High-priced-to-earning stocks are outpacing low multiple names, growth assumptions look stretched, and relative value is tilting toward bonds as free cash flow yields lag 10-year Treasury yields near 5%. Leadership is also changing. After a long run of outperformance, several mega-cap tech stocks have sold off together, semiconductor indices have seen intraday drops close to 10%, and there is evidence of a pronounced rotation into value, quality, and more defensive sectors. Small caps are outperforming large caps this year. Healthcare and financials are seen as under-owned and relatively cheap, and even defensive growth stories in pharma and defense are drawing renewed interest as potential ballast if volatility increases. Another challenge for equities is sheer supply. Large capital raises from big technology companies, plus an approaching wave of AI-related IPOs, such as SpaceX, OpenAI, and Anthropic, could inject hundreds of billions of new equity into the market over the coming months. With limited cash on the sidelines and history showing that major tech IPOs often experience drawdowns of more than 50% in their first year, there is a real risk of temporary indigestion as investors sell existing winners to fund new issues, especially if upcoming inflation data and the Federal Reserve meeting unsettle rates at the same time. Moving to rates, the dominant story is the market's shift away from an easing bias toward the possibility of renewed tightening. Pricing now embeds the chance of up to 3 Federal Reserve hikes starting as early as December, and the 2-year Treasury yield has pushed above the effective funds rate, signaling that investors see a meaningful risk of policy needing to catch up. Several forces are driving that repricing. AI-driven investment is boosting demand and adding to inflation rather than easing it, while headline consumer prices are expected to rise to around 4.2% year-over-year, and core personal consumption expenditures are seen drifting toward 3.4%. At the same time, long-dated Treasury yields are hovering near 5%, and the curve is flattening as front-end yields rise, reflecting worries about persistent inflation, large fiscal deficits, and a higher neutral rate. Policy uncertainty is unusually high. Options around front-end policy rates are effectively splitting the odds between no further moves and a full percentage point of additional hikes, and the upcoming June Fed meeting under the new chair is widely viewed as a credibility test. Markets expect the central bank to drop its easing bias and potentially scale back forward guidance, giving itself more optionality, even as strong labor data, rising inflation expectations, and political noise over rates all pull policy in different directions. For allocators, this leaves rates as the key cross-asset anchor. Investors are increasing exposure to short-term paper globally, taking advantage of higher yields while diversifying by region, and many see long-end yields around 5% as a deliberate break on equity exuberance. The strong inverse correlation between bond yields and equities means that every inflation print and every Fed communication now has the potential to trigger outsized moves across risk assets. Credit markets, at least on the surface, still look remarkably stable. Investment-grade yield around 6% are being viewed as compelling income, with some investors more relaxed about duration risk and willing to extend along the curve. High-yield spreads near roughly 2 and 2/3 percentage points over treasuries remain tight, signaling manageable financing conditions despite higher base rates. That yield backdrop is changing the relative value debate. Bond yields close to 5% are seen as attractive versus long-term equity return assumptions, and flows into high-quality segments, such as municipal bonds, have surged to near-record levels as investors search for tax-efficient income and lower volatility. Municipal credit fundamentals look strong, with upgrades outpacing downgrades and healthy reserve positions, although this market is acutely sensitive to moves in Treasury yields, and any surprise from the Fed could trigger a bout of volatility. Under the surface, however, the credit landscape is evolving. Global government debt has roughly doubled over 2 decades, and investors are increasingly demanding higher risk premia from sovereigns relative to high-quality corporates as fiscal credibility comes into question. At the same time, private credit is scaling up rapidly, illustrated by the $35 billion AI chip financing, where investment-grade style tranches backed by Broadcom are yielding about 8.5%, and supply of similar deals is expected to grow. Private equity investors are also voicing concerns about liquidity as slower exits and valuation uncertainty delay capital return, and dispersion between top and bottom quartile managers has widened dramatically compared with public markets. For allocators, the combination of tight public spreads, rising sovereign risk premia, and growing private market liquidity risk argues for close monitoring of any widening in credit spreads relative to moves in rates, especially around Fed meetings and bouts of equity volatility. In foreign exchange, the picture is more nuanced than simple dollar strength. Despite robust U.S. growth and rising rate expectations, the dollar is underperforming what its fundamentals would suggest, likely reflecting structural diversification flows and greater use of currency hedging on U.S. assets. That disconnect leaves room for abrupt moves if the policy or inflation narrative shifts. Elsewhere, policy divergence is increasingly visible. Indonesia's central bank delivered an unscheduled rate hike to support the rupiah amid regional currency pressure, and other emerging market central banks are acting preemptively as well, showing that policymaking has improved since past crises. In Europe, the central bank's inflation focus may give the euro short-term support, but weaker data and firmer U.S. growth still point to downside risks for the currency over time. Crypto sits on the risk-off side of this equation. Bitcoin's recent slide below $60,000, compounded by a rare sale from a large corporate holder, has dented confidence in the digital asset treasury model. Higher real yields, geopolitical uncertainty, and an unclear policy path are all weighing on the asset class, underlining how sensitive it remains to shifts in global liquidity and risk appetite. Finally, commodities remain the wild card for both inflation and growth. Oil markets are grappling with significant geopolitical choke points, including slow shipping through the Strait of Hormuz and rerouting around Africa as shippers avoid the Red Sea. Global crude inventories have fallen from roughly 8 months of cover to about 6, and major producers have so far been reluctant to increase supply. Analysts warn that if these trends persist, oil prices could spike as high as $125 a barrel later in the summer as inventories approach critical levels, particularly with jet fuel markets already tight and Middle East production taking months, not weeks, to normalize. For now, Brent has actually eased from around $98 to the low 90s as markets fade geopolitical risk, but that may understate the probability of a prolonged conflict or supply shock. Beyond crude, the energy transition theme is resurfacing. One major bank expects lithium prices to rebound ahead of a new electric vehicle production cycle, which could support lithium-related equities and reinforce the link between green metals and future inflation dynamics. For multi-asset portfolios, the key question is whether an energy or metal shock becomes the catalyst that forces a more aggressive policy response and reprices both bonds and equities in the second half of the year. Stepping back, the cross-asset picture shows powerful but conflicting forces. Equities still enjoy strong earnings and an AI-driven capex boom, yet valuations, narrow leadership, and a looming wave of issuance leave them more sensitive to rates, oil, and volatility than earlier in the year. Rates are re-anchoring around a higher for longer narrative as inflation proves sticky and the new Federal Reserve leadership faces an early credibility test. While credit remains calm on the surface, even as sovereign risk premia, private market liquidity concerns, and tight spreads limit the margin for error. In currencies and crypto, policy divergence and a surprisingly soft dollar meet more proactive emerging market central banks and a fragile digital asset complex, and commodities, particularly oil, hold the potential to re-accelerate inflation just as growth tailwinds from fiscal policy start to fade. For allocators, the next phase is likely to be defined by how inflation data, the Fed's messaging, and energy supply interact with a heavy equity issuance calendar and bond market valuations. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.